afternoon. A steady improvement in vaccination rates will sustain confidence and global economic growth, even with expected further waves of the COVID-19 virus. However, vaccination rates are lagging in many emerging markets and developing economies. Until populations develop sufficient immunity to cap virus transmission, waves of infection are likely to continue with ongoing poor economic outcomes. At this time, the third wave of the virus infection has peaked in South Africa. The virus, however, is only one of a series of current risks to the economic recovery that includes rising inflation, weaker commodity export prices, and the longer-term impact of scarring from the pandemic and the July unrest. The International Monetary Fund's forecast for global gross domestic product for 2021 is 6% and will be updated again in early October. The SARB's forecast for global growth in 2021 now sits at 6.2%. For 2022 and 2023, we still expect global growth of 4.4% and 3.4% respectively. Recoveries in emerging market and developing economies are expected to lag those in advanced economies, in large part due to a slower pace of vaccinations. Although policy settings in advanced economies remain accommodative, the spread of the Delta variant, higher global inflation, and uncertainty about the normalization path for interest rates continue to cause financial market and capital flow volatility. Risk aversion persists where economists fail to take advantage of improved global prospects or to reduce large macroeconomic imbalances. The domestic economy grew by 4.2% in the first quarter of 2020 and by 4.7% in the second quarter. The outcomes reflect better sectoral growth performances and robust terms of trade. Commodity prices have been extraordinarily high, sustaining income gains despite somewhat higher oil prices. While more South Africans have re-entered the jobs market as economic activity resumed, the loss of jobs suggests persistent adjustment and sustained weakness in some sectors. Household spending remains healthy. However, in line with better than expected salaries and wages, rising asset prices, and low interest rates. The bank's forecast for fixed investment was revised up for this year, but remains constrained. And as a result of the GDP revisions by Statistics South Africa, is lower as a share of economic activity. We expect the economy to grow by an upwardly revised 5.3% this year, despite the much larger negative effect on output than was previously estimated from the July unrest. Our revised estimate for third quarter economic growth is negative 1.2% compared to the previous negative 0.5%. Output in the manufacturing sector fell by 8% in July alone. Mining was up 4.1%, while land freight transport fell by 5.0%, and retail output was down by 11.2%. The July events and the pandemic are likely to have lasting effects on investor confidence and job creation, impeding recovery in labor-intensive sectors hardest hit by the lockdowns. GDP is expected to grow by 1.7% in 2022 and by 1.8% in 2023. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to be balanced, as most of the bounce back from the recovery is now behind us. High export prices are expected to fade, while very weak job creation will slow household consumption. Investment will remain constrained by the still limited energy supply and ongoing policy uncertainty. The faster vaccine rollout presents upside risks to the growth outlook. The current account surplus remains large at 5.6% of GDP, reflecting high prices for mining and agricultural exports, still growing, gradually rising oil prices, and slowly reviving demand for imported consumer and investment goods. The surplus is expected to shrink to about 0.7% of GDP by next year as exports slow and imports accelerate. Long bond yields have returned to pre-pandemic levels of around 9% on 10-year bonds. Although financing conditions have improved and fiscal risk has eased, the yield curve for rand-denominated bonds remains steep. The generally favorable global conditions and strong commodity export prices have strengthened the currency above its long-run equilibrium level, with a year-to-date appreciation of 1.5% on a trade-weighted basis. Since the July meeting, the rand has depreciated by 1%. The implied starting point for the rand forecast is 14.47 rands to the US dollar compared to 14.40 rands at the time of the previous meeting. At a global level, a wide range of prices is accelerating, including raw materials, intermediate inputs, and food. This reflects both global supply shortages and strong demand. This has passed through to consumer prices in some major economies. Our estimate for inflation in G3 was revised higher for 2021 to 2.4% and remains the same in the outer years. Oil prices are revised up for this year, and petrol price inflation is higher at 16.1%. Local electricity prices are lower at 10.1%. Headline consumer price inflation for 2021 is revised slightly higher to 4.4% and remains unchanged at 4.2% in 2022 and 4.5% in 2023. The forecast for core inflation is revised higher to 3% in 2021 and to 3.8% in 2022. Core inflation is expected to be 4.3% in 2023, unchanged from the July forecast. The bank's forecast reflects higher headline inflation for the rest of this year before moderating in 2022. Compared to the July meeting, and taking into account higher household consumption and less investment from the recent GDP revisions, the output gap is narrower historically and over the forecast period. While economic activity continues to expand over the forecast period, a rise in core inflation is moderated by the current strength of the exchange rate and modest unit labor costs. The risks to the short-term inflation outlook are assessed to the upside. Rapid global producer price and food price inflation have surprised to the upside in recent months and could do so again. Oil prices have become more volatile in recent weeks and could rise beyond our expectations. Electricity and other administered prices also continue to present short-term risks. Given the medium and long-term projections set out above, a weaker currency, higher domestic import tariffs, and escalating wage demands present further longer-term upside risks to the inflation forecast. Average surveyed expectations of future inflation remain unchanged at 4.2% for 2021 and 4.4% for 2022. Market-based expectations for inflation are slightly higher for 2021 at 4.4% and stable over longer horizons. With largely unchanged inflation expectations and even with continued upside risks, the committee expects inflation to stay close to the midpoint of the inflation target over the forecast period. Against this backdrop, the MPC decided to keep rates unchanged at 3.5% per annum. The decision was unanimous. The implied policy rate path of the quarterly projection model indicates an increase of 25 basis points in the fourth quarter of 2021 and further increases in each quarter of 2022 and 2023. These repurchase rate levels reflect a highly accommodative policy stance through the end of the forecast, keeping financial conditions supportive of credit demand as the economy continues to recover. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms. Better anchored expectations of future inflation could keep interest rates lower for longer and can be realized by achieving a stable public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage inflation low into the recovery. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second round effects. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes the MPC statement, and at this stage, we would like to turn to you, Zianda, to invite questions from members of the media.
Thank you, Governor. We've got 4 questions from Funeko at Business Maverick. How relevant is the gap between headline and core inflation? Is lower core inflation rate relative to the headline CPI evidence of a long trend drop in prices? The second question is the fact that inflation expectations are anchored lower solely a function of the SARB's successful policy implementation, or has the power balance between labor and employers shifted fundamentally in favor of employers? More so since the wage increment agreed between government and public sector employees. Third question, should we be excited about lower inflation if it is largely an effect of weak demand and a weak economy? Fourth question, what does narrowing output gap suggest about inflation pressures in the economy? Those are the questions for now, Governor.
Mfuneko, your questions are contradictory. Because you see, if you say inflation is a function of weak demand and weak economy, then the output gap would not be closing. The output gap is closing precisely because you have had economic activity rising. We have revised growth for this year to 5.3%. We have had revisions to the potential growth, but the revisions to the real economic activity are higher than the revisions to potential growth. So you can't have it both ways, Mfuneko. You can't say that inflation is as a result of weak demand, and also say that, well, the output gap is closing. And yes, it's precisely because the output gap is closing that we have also revised inflation marginally higher, and that when we look back, the output gap in the years up to 2020 was actually narrower than was initially thought. Now, the issue of inflation expectations, you are asking whether inflation expectations are a success of the SARB. Well, that plays an important role because you see, since the SARB emphasized a focus on the midpoint of the inflation target range at 4.5%, inflation expectations have converged towards that. But then you are asking the question, well, is this a change in the balance of forces between business and labor? That is not something that one could easily say. What we do know is that during the pandemic, lots of goods and services were not available. People were not consuming, yes, and that could have brought the things down. But the trend of what has been happening to inflation expectations for South Africa goes back a good 4 years now. From around 2017, inflation expectations have been coming down. Yes, a credible central bank plays a role, but as we have also spelled out earlier, unit labor costs have been coming down, and unit labor costs have been coming down as a result of increases in productivity. And that had helped to bring the inflation down. But I think that what we shouldn't underestimate is that an emphasis on driving inflation lower in this economy changes the behavior of price setters. And so it is not just unit labor costs are coming down, but it is that prices across this economy have been rising at a slower pace. So if you look at the inflation basket, you would actually realize that if you exclude administered prices, all the other prices in this economy have been rising at 3.5% below the midpoint of the inflation target range. And that is what we are seeing in this economy. In terms of core and CPI, I'm not quite sure I understood you, but I can always refer you to the others here. The way in which we view core is that core measures the underlying inflation pressures in the economy. Because core, in terms of the sub-preference of measurement, is headline inflation excluding energy, oil, and food prices, which are the stuff that we consider to be volatile. And so when you say we look at core, we see core as giving us an indication of broader price pressures in the economy. And core had been contained for so long, and we expect it to be contained this year and next year. And even in the outer year in 2023, where it rises to 4.3, it will still be remaining below the midpoint of the inflation target range, which then tells us that inflationary pressures then are contained. So our focus thus should be on those administered prices and those price setters saying that, well, this is where the inflation target range is. We are focused on the midpoint of the inflation target range. Other prices in this economy are rising at around 3.5%. You guys are out of line with what we are trying to achieve here. SARB MPC members, does anybody want to add anything? No? Okay, clear as mud. Zianda?
Thanks, Governor. Let's see, one more question. Oh, we've got 4 questions as well from Pranisha at Bloomberg. Governor, you've made it very clear earlier this month that you'd prefer a lower point target for inflation. Have you since started talks about lowering the target with the finance minister? The Fed last suggested that it beginning scaling back asset purchases as soon as November, and that it will raise interest rates next year. To what extent is the potential impact of that included in today's statement, and how will this affect your decision making? Markets are concerned about China Evergrande Group's liquidity issues and potential spillover effects if it's unable to fulfill its obligations. To what extent could this affect South Africa and local markets? Last question. Earlier this week, the finance minister cited declines in GDP per capita, productivity, and record high unemployment as reasons to why the current state of South Africa's economy is unstable. What do you make of this, and what can the central bank do to help things get better?
Last question, wrong press conference. You can refer that question to the Minister of Finance, and then he can tell you what he meant by that. China Evergrande, we have not picked up any direct connections from South Africa with China Evergrande. I think there might be one or two players with an exposure to one of the shareholders of Evergrande, but we have not seen that. I think that the impact of this Evergrande thing is going to be on sentiment towards borrowers globally, and borrowers in particular from emerging markets. But we have not picked up any direct exposure from here, and we will continue to monitor if there is any contagion that comes from there. The third asset purchases, we don't factor in any of these things in our decision-making process. We have always said this, and let me repeat what I have said, that when policy begins to normalize in the US and the advanced economies, there will be a repricing of financial assets and a realignment of global exchange rates. And we are going to be watching that. And so for South Africa, as a small open economy, as the advanced economy central bank normalizes policy and financial assets reprice, there might be capital outflows, there will be movements of capital, there might be capital outflows as that policy normalizes, the exchange rates might depreciate. Our focus as a central bank would be to see whether those movements of those variables lead to second round effects and thus a rise in inflation, and that is what we would be responding to rather than the actions that had been taken by the advanced economy central banks. And so in as far as South Africa is concerned, this normalization will find South Africa in a better position than we were in 2013. And the reason for that is very simple. At the moment, South Africa is running a significant current account surplus. When the first taper tantrum took place in 2017, we were running a current account deficit. And so we are less vulnerable than we were then. We expect that the current account surplus will unwind and that we will eventually, by 2023, even record a modest deficit. But that just means that South Africa is better prepared than 2013. Secondly, if the current consolidation path that the Treasury has embarked on continues on the current trajectory that we had seen, and that we take advantage of the shock, the overruns in revenue to lock in the gains of the fiscal consolidation, then we will be able to weather the storm better than what we would have otherwise had been in 2013. Thirdly, in 2013, our inflation was closer to the upper level of the band, of the inflation targeting band. We are now having inflation expectations anchored around the 4.5% level, and that even on a forward-looking basis, we expect the outlook of inflation to be closer to the 4% 2.5% level. And even as inflation was rising elsewhere in the world, we have seen inflation contained in South Africa. We are not insulated from the global developments with respect to inflation. We are cognizant of those risks, but even taking account of those risks, we actually feel that South Africa is in a much more firmer position now than we were at the time of the previous taper tantrum. And we are cognizant of the fact that the Fed now is communicating much more clearly than they had communicated in 2013, and that they are preparing the ground through constant communication of what their trajectory in terms of the unwinding of the support measures that had been put in place had been. In terms of the inflation target pre-measure, you are asking the same question that you asked 2 weeks ago. And let me state the following. The inflation target was introduced as 3 to 6. In 2001, the Minister of Finance and the Governor of the Reserve Bank agreed that the target should be lowered from 3 to 6 to 3 to 5 by 2004. They further agreed that the target range should be reduced to 2 to 4 once we have locked the gains from the lower inflation. 2 to 4, the midpoint of 2 to 4 is 3%, which is what I communicated. So I was not bringing anything new. I was bringing in what the Minister of Finance and the Governor of the Reserve Bank previously agreed on, but decided at that time not to announce the 2 to 4% target. We experienced a shock in 2001, the Argentinian default and the depreciation of the rand. And in 2001, in February, there was an agreement between the Minister of Finance and the Governor to reinstate the 3 to 6% inflation target, and that at an appropriate time, we will go back to the glide path that had been proposed. Well, the Minister of Finance changed and the Governor changed, and no one remembered that that is what we had said to South Africans was going to be done. And all that I've been doing was to restate what was agreed at that particular time. We have not had conversations with the Minister of Finance as yet. There is a macroeconomic review that is taking place that is led by the Treasury. The South African Reserve Bank is engaged with it in as far as that macroeconomic review has got an impact on the inflation targeting framework. And we will continue to engage with that process. It's a technical process where we have got officials from the Treasury and from the Reserve Bank that are engaged with that process. And they will then advise the Minister and I on what is to be done. So I've expressed this preference of a lower inflation target at 3% for the simple reason. Our inflation target is out of line with that of our peers. And we had previously stated that we wanted to move lower. Once again, there is no virtue in higher inflation. Higher inflation begets higher interest rates. If you want lower interest rates into the future, you have got to drive inflation lower. We are able to provide the accommodation now precisely because inflation is lower. If inflation was higher, we would be having higher nominal interest rates. You can watch across the Atlantic in the southern cone and see what is happening with countries where the inflation is rising. Their interest rates are rising higher. You can look elsewhere in Asia where inflation is going higher, interest rates are going higher. There is no virtue in higher inflation.
Thank you, Governor. We've got a question from Atol Dlamini at Alliance News. He's asking, is the SARB concerned about the timing of normalization given inflationary pressures and hikes in rates in other emerging markets? Alex Winning from Reuters had a similar question to what you've just responded to on the inflation target, but he closes it off by asking, when do you think the earliest such a target could be introduced? Alex's second question, could you explain a bit more about why you raised your 2021 GDP growth forecast so significantly? Is it mainly because of the better than expected performance in the first half? Governor, can I give you a last set of questions from Mfuneko and Alex, then we can close? Mfuneko from Daily Maverick. Has COVID-19 provided an opportunity for greater coordination between monetary and fiscal policy? Is the current constitutional arrangement still fit for purpose? Interest rate differentials in SA are lower compared to other emerging market economies. Is this a concern for the MPC? Equally, are you worried about the still steep yield curve? Last question, can macroprudential policy improve the effectiveness of monetary policy transmission? Is this something the MPC is thinking about? Those are all the questions, Governor. Thank you.
Are we concerned about normalization? Well, no, not quite. But we do watch normalization and how it affects South Africa. And I think that in my earlier response explaining how we take account of the first decision, that is how we take account of that normalization. And Alex also asked the question about what is the earliest we can move to a lower target. We do not have. The review is underway. We have just stated that that is where we think that South Africa should end up. GDP revisions in 2021. Chris, or Rashad, one of you, you must take that one. What is in no doubt is that we had recovered faster than we thought we would recover, but also bear in mind that last year the revisions meant that last year was not as weak as we thought it would be. So, Chris, Rashad, I'm going to leave that with you. Mfuneko, I do not understand why monetary and fiscal coordination would need COVID. That is what we have been doing all along in South Africa. We have got standing committees between the Reserve Bank and the National Treasury that are looking at coordination of fiscal and monetary policy. Furthermore, the Public Finance Management Act does state that the National Treasury is responsible for the coordination of monetary or of macroeconomic policy. But then you stretch this thing further and you ask whether our constitution is still fit for purpose. This constitution has served us well. It obligates that the Minister of Finance and the bank have regular consultation. We have put in place structures that will enable and facilitate that regular consultation, and we think that it is serving us well. Interest rate differentials between us and the rest. Interest rate differentials, yes, do matter. People look at those, but for an economy with an advanced financial market like ours, what matters is not the differential in policy rate. What matters is a differential in bond yields. And at the moment, the differential in bond yields is in favor of South Africa. And again, Nomfuneko, today you keep on contradicting yourself because you also asked the question about the steepness of the South African yield curve. And the point here is that, yes, the South African yield curve is steeper than the yield curves elsewhere, and it is that bond yield differential that is in favor of South Africa. But we also, in the statement, do mention the steepness of the curve, because it might be reflecting the fact that there is still uncertainty about the fiscal risks that we might be facing, which is why I kept on emphasizing that the current fiscal consolidation has benefited us, and if sustained, will stand us in very good state as policy rates normalize internationally. DG Naidu, can you answer the question about macroprudential things? These are the things we have done, of course, last year to support the economy. But Chris, shall I start with you? Or Rashad, you want to start? Go for it, Rashad. Oh, Chris, go.
Rashad, go. Okay. Yeah, look, I think that every time you see a kind of an upward revision to the GDP, there are a few things that matter. The one is that the starting point of the quarterly numbers that we look at turn out to be better than expected. So that is one factor that drives an upward revision. But I think what's also important in the logic of the model is that in 2021, the potential of the economy has been revised upwards. So that has an effect on an upward revision of the GDP too. Also bear in mind the point that the governor made is that I think that the revisions in the GDP were important, notwithstanding the fact that there was no particular pattern in the GDP revisions as far as growth was concerned, but in the more recent past, like for example in 2020 and some of the quarters, there has been an upward revision in GDP, and that gives us a sense that there's a bit more robustness in the economy in the short to medium term, say 2021 in particular, than we would have thought, and that contributed to an upward revision of GDP for 2021. Thank you.
Let me just add a tiny bit to that. Just to remind you that the quarterly forecasts in our various MPC meetings changed greatly over the course of this year. So the January meeting, we thought we would have a slight negative first quarter outcome, in part because there was a very strong fourth quarter 2020 outcome, but also because of the lockdown that was in place due to the virus wave that we were experiencing earlier in the year. And that first quarter growth rate has been revised up systematically. I think by the March meeting, we were at about 1.5% positive. That changed to 2.5% positive by July. So that first quarter number has really moved massively over the course of this year, and that's helped propel the whole year's growth rate higher in a major way. The first quarter, I think, was about 4.6. So it's a very large movement relative to what we originally had forecast. Thanks.
Naidu?
Thanks, Chair. For ECO, we did use macroprudential and other tools to improve the monetary transmission mechanism last year. On the macroprudential side, we provided regulatory relief to the banks. We lowered their liquidity and their capital requirements. And we also provided effectively a capital holiday for restructured loans for people who were suffering from distress as a result of COVID. So payment holidays, restructured loans did not attract a higher capital requirement. Those are macroprudential tools that we use to enhance the efficacy of monetary policy. But we also made some interventions on the money market side, in the financial markets, in the government bond side, in the liquidity side, providing additional liquidity. All of those contributed to improving the efficacy of the monetary transmission mechanism, particularly in that March-April period last year when things were really hellish in the markets. And there was, in some cases, a disorderly relationship in some parts of the market. Thanks, Chair.
Thank you very much. That concludes the proceedings of today. We will see you at the November MPC. Thank you very much for your attendance. Goodbye.